Well, I think earlier this year we acknowledged that this would go on for longer than we expected. And I think certainly we should not expect this to resolve itself in a couple of weeks. This is going on for months and months. And I think for the rest of this year, this really will be the theme of investing in Asia. But what we had done earlier this year is acknowledged exactly that and taken off some of this exposure, certainly for China exporters, where traditionally we've had minimal exposure because we've been more about domestic stories. But I think if you look at what we have now, it's very much a domestic base of names in Asia, in China, sorry. And that we think will perform well. So there was some short-term volatility, of course, but operationally we've not seen any changes. And the numbers coming through, whether at a micro or macro level, are still fairly resilient. So, we think as long as you're in the right area, you can see out this volatility and then end up with something that probably rebounds very sharply.
Do you worry, though, that things could go so badly that it does start to have an impact on the China domestic growth story? Because we often portray this story as a tit for tat in terms of who has more in their toolkit to fight this battle, if you will. But I wonder if we should really be asking who has the greater pain tolerance when it comes to tools at their disposal to either prop up the economy or help certain industries. Do you think China will resort to more measures on that side?
Well, I think that scenario, domestic companies have a higher pain threshold. And the reason for that is that if you look at the kind of fiscal surplus that China has right today, they have the ability to expand fiscal policy. And that kind of expansionary policy will be very, very helpful for consumers, for domestic companies, and so on. And then, of course, you can see more lending as well. We've seen a tighter environment because of this clampdown on shadow banking, off-balance sheet debt, and so on. So you could see a little bit of an unwind in that regard. And so you start seeing reserve rate requirement, cut by 100, 200 basis points. And that provides some good short-term support.
Do you think expectations of further easing from the PBOC, perhaps for their other fiscal stimulus measures even, is part of the story of yuan weakness we've been tracking? Or do you think there is going to be a deliberate attempt to keep the currency low?
Well, actually, I don't think, if you look year to date, the currency is not so bad. And I think recently there's a lot of noise about what's happened over the last 1 or 2 months. But if you ask me right now what I'm concerned about, it's not the Chinese currency, it's the Indonesian, it's India, and it's Philippines, which we've said consistently at the beginning of the year is in the areas that we want to avoid. And I would still say the same thing, that we have less than 2% exposure to those 3 economies, and that will continue to be the case.
Is that based on your expectations for dollar strength on the back of the Fed and all those countries with current account surpluses that are most vulnerable?
Well, we think the dollar's had a decent rebound, and that, in our view, was expected. We weren't quite so sure why it'd come off, but that the dollar strength is one part, but I think the individual economies there are also quite weak as well.
Just quickly, Sat, also some lines coming out from the South Korean ministries today saying that, look, we could see some impact on intermediary goods. Is this an area of concern? Would you be avoiding certain areas of the South Korean market, too, that are so exposed to these trade tensions?
Yeah, so traditionally, as a more of a value income strategy, we've had less exposure to the supply chain names in, say, Taiwan, Korea, and so on. So I think, those were areas that you should have avoided. You should have seen this coming, I think. So we were quite clear that we didn't want to be in that area, and I think we've avoided that quite well.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.